What's up, guys? I'm Mike from StockedUp. In this video, I'm going to be showing you guys a very important lesson when it comes to options trading, especially in today's market with crazy volatility. And we're going to start off just by making this clear. Like, you guys, I know this is probably a basic rule and you heard it before, but to truly understand it is you do not have to trade every day. Some of the best traders trade the least. So, the market is extremely volatile. I mean, look at the SPY for the past 2 weeks. It falls 4,500 points. Then it rebounds over 1,000 points. Then it falls over 1,000 points. And then it rebounds over 1,000 points again. And then it falls over 1,000 points again. So the market is very volatile right now. And it's almost impossible to predict in the short term. Now, this is why I'm going to be showing you guys a very important lesson today. And it comes with options pricing. Now, you guys have to understand the concept of like expensive and cheap options. Watch this video to the end. Trust me, you are going to learn something. So, GILD, for example, what makes a cheap option and what makes an expensive option? Now, the most simple answer is look at the implied volatility. And when I say that, look at the relative implied volatility. So, like, for example, if we look at like Johnson & Johnson, we could see like right now, the implied volatility is 0.37. And that's pretty high because look at the implied volatility right here compared to where it was in the past 6 months. And now if we look at a stock like Boeing, we could see right now the implied volatility is 0.65, which is almost double that of Johnson & Johnson. And this is also expensive. So my point is you do not want to focus on the number. Don't focus on whether it's 0.3 or 2.0 or 0.6. Don't worry about that. What you should be worrying about, or at least looking at, is look at where the implied volatility is now compared to where it has been in the past 6 months. So for example, Boeing, the implied volatility is pretty much higher than it has ever been in the past 6 months. The options are expensive. But if we go to a stock like, even here, I can't even find a stock right now where there's going to be cheap options. I mean, it's going to be really hard to find one, but I'll give you an example. Like if we were to like Coca-Cola, this is a good example. So Coca-Cola right now, the options are expensive. The implied volatility is right here. In the past 6 months, it has been low, like right around here. But when the implied volatility was low right here, it was like as low as it's ever been in the past 6 months. So it would make the options cheap. The bottom line is take the implied volatility where it is now compared to the past 6 months. If it's, higher than normal, the options are expensive. If it's lower than normal or mid-range, the options are fairly priced or cheap. Now, here's the thing. With expensive options, when options are expensive, it means volatilities are rising. It means either earnings are coming up or the market's going crazy like it is right now. But here's the thing. No matter what, when you're trading expensive options, the odds are not in your favor because the options are so expensive and the options decay a lot more. So I'm going to show you what I mean. If we take a look at Guild right now, today, yesterday Guild closed at about $76. It ran up to highs of $77.50 today and ran down to lows of $74.53. It had a lot of movement. Let's take a look at the options chain. The calls fell 2%, 13%, 22%, 15%. Oh, what about the puts? The puts fell 26%, 27%, and 40%. No matter what happened, at the end of the day, the calls and the puts fell. So that has to do with, the options are expensive, and pretty much on like a day-to-day basis, the close is about the same as it closed yesterday, but what happened, why these contracts fell, is because, yesterday, today is Thursday, right? Yesterday, these options had 2 days worth of time. They had all Thursday and all Friday. But, there's only a day left of time left in this. Like, these options expire tomorrow, so the options lose value. Now, I'm going to show you another example. Let's take a look at SPCE, and this is the crazy thing. So, implied volatility on SPCE is sky high compared to where it's been in the past 6 months. Let's say you bought an SPC. So let's go to, let's say on February 28th, you bought a straddle on SPCE. You bought a call and a put at the 25 strike. So you bought a 25 strike call and you bought a 25 strike put. SPCE moved a little bit since that time. So we could see SPCE went from $24.60 to highs of $28. That's a really big move for, a $24 stock. Well, you would think that, the stock's moving, the options should too. From the 28th, the straddle went from $651 to $410 to $315 to $243 to $188. It literally fell every single day, and that's because the options are so expensive. So the moral of the story is, one, be very careful when you're trading expensive options. Money can be made when options are expensive. Like SPY options right now are very expensive. Money can be made on those. Like, for example, if you buy a put on the SPY tomorrow and it falls 1,000 points, you're gonna make money. But the risk, it's very, very risky, and it's generally hard to make money when options are expensive. Whether you're trading stocks or futures or whatever. Keep that in mind. The next moral of the story is, guys, you don't have to trade every day. If there's no opportunity, don't force it, especially when options are expensive, because it's not a good setup. Time decay is brutal. So, and the last lesson is time decay is worse. It's the absolute strongest on closer to expiration dates. So pretty much if you're trading weekly options, then the time decay is going to be a lot more than if you're trading an option that expires in 2 months from now. So keep that in mind. If you guys learned something, let me know in the comments down below. Feel free to subscribe. Hit that like button. If you guys have any questions or anything, let me know in the comments down below. But other than that, thanks for watching.